Joining us right now on set to weigh in on this week's Fed decision, rates, and the recent volatility that we've seen in bank stocks is Tom Michaud. He is the president and CEO of KBW. That's a Stifel company. And Tom, thanks for being here today. Thank you. Where do you want to start with this? We do have a Fed decision this week.
Yeah.
Maybe we get that out of the way first.
Yeah.
What does it mean for the banks if they go 20, if they go
lower
55?
rates are going to help banks because just earlier this month, we ended the longest period of yield curve inversion in our careers. Yeah. And that is a tough environment for banks. So banks no longer having an inverted yield curve is going to help. And we think the Fed policy change will help. So we think that the banks have been sailing into a headwind in terms of revenues. They've had very little revenue growth. That is changing as we speak. And we think you'll start to see very slow revenue growth improvement in the back half of the year.
Usually when the yield curve uninverts, it signals that a recession is just around the corner. You think that's the case this time around?
Which gets us to the soft landing, hard landing. I listened to some of your other speakers beforehand. Like if I had a crystal ball and if I had that answer, that's the answer we want. I will tell you, through our lens, through the banking system, it's hard to see evidence of a hard landing.
Okay.
So we're still in the soft landing camp. And then the other thing I'd say as an observer of the banking sector, we need orderly. When you start having surprise 50 basis point changes up or down, the banking industry was not built to respond to that. It can respond to that,
really?
Nor the markets. I think orderly.
What does it do? If it's not 25 basis, like marching.
Well, the industry will be, if it's 50, the industry will adapt and be fine. What the industry likes is orderly. Remember, there is a little bit of a duration that happens in a bank balance sheet.
Yeah.
And so typically where they're borrowing deposits and making loans, there's a little bit of a time difference. And so when the yield curve is inverted and rates are swinging around, it just makes it a little bit more difficult to manage.
So forget about investors being made nervous by a 50 basis point cut. What matters is bankers and how they figure out who they're loaning to, how and why.
Exactly. And actually, the story of the industry is that the economy is slowing. The Fed's actions are working. You're seeing it. There's no loan growth in America. So we need lower rates to get loan growth. You want heat to come off the commercial real estate sector? It'd be great if rates were 100 basis points lower. So these are good.
But not overnight.
Not overnight, because disorderly is never good for the banking industry. The banking industry likes orderly. I think 25 basis points is orderly. That's what I think they should do, because really, when you look at commercial credit in America, it's better than average. Where you're starting to see cracks are in the consumer. And last week, there were a couple of new data points that made investors cautious. But just this morning, Capital One came out with their August data, and it showed things are pretty stable. So it's not clear. Clearly, if you're a non-prime consumer, inflation has caught up with you. And in all my channel checks, employment has shifted. I'm hearing that employers now can find people more easily than they could a year ago.
So you're talking about letting up on the brakes slightly. I would say tapping on the brakes, but it's
and there's a delay too.
Analogy.
But I will tell you, my opinion is investors, at least in financials, will see if they see 50 basis points, they're probably going to say, what is the Fed seeing in the economy? Because the investors would be more nervous of a hard landing than a soft landing, and they'd want to know if that's a key data point that's suggesting that's going to happen.
Okay. That's an interesting perspective that we probably don't spend enough time focusing on. What about the Basel III new requirements that are out there? A lot lighter than the original proposal?
So we were expecting there to be an adjustment, and we got the adjustment. And so we didn't change earnings estimates after the new proposal, which suggests, so it was basically baked into our expectation. I think the bigger picture here, Becky, is regulation's been pounding on the banks for several years. Banks are only half of financial services today. You know, you look no further than mortgages, mortgage origination. Pre-global financial crisis, 7 of the top 10 mortgage originators were banks. Today, it's 3. What changed? Did they forget how to make mortgages? No, it got more expensive because of regulation. So I think backing off on this regulation, the banks, in my opinion, will still be safe and sound, which is the primary goal, but it's going to allow them to be competitive.
Who are the lenders now if only 3 of the 10 are the top mortgage ones? Who fills up the rest of the top 10?
Maybe Rocket Mortgage.
All these small guys.
For
all
example.
The guys who don't have the same sort of oversight.
They only usually get 1 regulator. If you're a bank, you have the honor of having 3 or 4. And also mortgage servicing, where you make a lot of the money, they put such a high capital charge on it. Banks just don't do it.
Does that set us up for a potential problem if all of that regulation, if all of that is happening in the quieter shadow places of banking?
My opinion is we do need a broad overview of the entire financial services sector, because a lot of competitors get a lighter touch. They should level the playing field, in my opinion. I think that we will be happier 5 to 10 years from now if that happens. But yes, I mean, look, I think the most spectacular failure of last year was FTX. They were doing activities that had been illegal in the United States since the 1930s. And yet we get no regulation there, but we get plenty of capital charges on the banks. Now, there were a couple of bank failures. That was due to interest rate risk, not credit risk. But still, there's been plenty of focus on what happened in the banks, but you're not getting as much. And by the way, there are a lot of really good companies that are non-banks. I'm not taking a shot at them. I'm just saying
we got to take we don't know.
We got to take a step back and take a big picture look. Yeah. That's my view.